Hey everyone, welcome back for another dividend investing video. Stocks go up, stocks go down, but as a dividend growth investor, I sleep well at night knowing my dividend income is increasing. And while the tech sector has had quite a month, value and dividend stocks saw declines, with the popular dividend ETF SCHD dipping below the $70 mark a few times in the month of May. There is a lot of opportunity for long-term, value-minded dividend growth investors, and I've found 4 stocks in particular I think are at a compelling place to be accumulating, or at the very least would look great on your watch list. I'm going to share those with you in this video, so let's get right into it. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Before I share my favorite stock picks for June, I want to highlight the criteria I used to help narrow down my candidates. In dividend growth investments, I like to see some different things. I want to see 10 plus years of dividend growth, and I want a company that's committed to raising its dividend for shareholders and has a demonstrated history of doing so. I'm looking for a PE ratio to be below its 5-year average, the idea being that often things revert to the mean, and if the fundamentals are there, this gets us the better value for our dollar. I'm looking for a dividend yield that is above its 5-year average to allow locking in a better starting yield. I don't care as much about what that yield is, at least at this point in my own dividend investing journey. But look, I'm a guy who's going to be in this accumulation phase for at least another decade. So I'm looking more at dividend growth and really total growth prospects. If we can get shares of our favorite dividend stocks when they are yielding above their typical, we'll be getting a better long-term yield on cost. Also, while not something I care too much about, all the picks are within 10% of its 52-week low. These are turnaround candidates. I want some upside potential. I want my investment to grow as much as I want my passive dividend income to grow. So here we go, 4 stocks for June. Stick around till the end. I'll highlight a few bonus picks that I think are honorable mentions that also belong on your watch list. All right. Stock number 1 is Amgen Inc., ticker AMGN. Amgen is in the healthcare sector and part of the biotechnology industry. They develop human therapeutics focused on inflammation, oncology, bone health, cardiovascular disease, nephrology, and neuroscience. At present, they are a $118 billion mega cap. Like many healthcare companies at this time, Amgen has been dropping in share price. It's down about 18% year to date and is sitting right above a 52-week low of $211 at the time of publishing. Let's look at its valuation. Amgen has a forward PE of 11.5, and this is 17% below its 5-year average PE of 13.9, and this is the lowest valuation we've had in the last 5 years. Shares of Amgen are yielding 4%, and this is 32% above the 5-year average of 3.01%. Amgen's dramatic share price decline this year, combined with its stellar dividend growth track record, has put shares of the stock in a place where investors could start a position today with a starting yield that is far greater than where it's been in the past. Now, Simply Safe Dividends gives Amgen a dividend safety score of 74, which is thought of as safe. Amgen's dividend is paid out as 46% of earnings and 44% of forward free cash flow, edging a little high for a biotech, but under 50% threshold that we'd like to see this at. Amgen has uninterrupted dividend growth streak of 11 years. They started paying their dividend in 2010, and with strong dividend growth at 11% on average per year over the last 5 years. Their latest raise back in December 2022 was at 9.8%. This is considerably better than some of the bigger peers in their industry such as Merck and Pfizer. Amgen is on the popular March, June, September, December payout schedule. They pay $2.13 each quarter for a total annual payout of $8.52 per share. That's a qualified dividend. Pays next on June 8th. The Wall Street analysts give Amgen an average price target of $253.55. This is over 18% upside from where shares are today. So in addition to that dividend income, we have some good upside potential here over the next couple years, I believe, with Amgen. Look, I identified Amgen as one of the best healthcare stocks to accumulate in 2023 at the beginning of the year, and I stand by this, and I've been building my own position here in my dividend growth income portfolio that I share here on the channel, and I plan to continue buying this one up. I'm down over 10% on my position, but when you are long-term minded, you see this as an opportunity. Before investing in a company like this, it is best to understand their medicine pipeline, where things stand with their patents, and the other pricing concerns that come up with these type of products. I think it's a good idea to diversify if you're going to invest in the sector, and I own others such as AbbVie, Pfizer, Johnson & Johnson. These are all solid dividend-paying companies. All right, the second stock I'm highlighting today is Kroger, ticker KR. Kroger is a player in the consumer staples sector and part of the food retail industry. They are a chain of grocery stores with locations in 35 U.S. states. They are the third largest grocer in the U.S. behind Amazon and Walmart. They also produce private label brands that on their own rival many of their competitors, and they control the productions of these products, which gives them superior profit margins. Kroger is an underrated dividend growth stock, in my opinion. While shares of Kroger are about flat year to date, over the last 12 months, shares are down over 13%, and in the last month, shares are down about 9%. Today, we were just a couple bucks above that 52-week low. Shares have become attractive again after they were flirting with $50. Now, back in January, I posted a video and gave the company a fair valuation, and I still stand by that 5 months later. I'll leave a link to that in the description of the video, and I'll probably make a follow-up video to that sometime later in the year. Now, Kroger's PE has dropped below 10. It's now 9.9. It's a sizable drop below the 5-year average of 12.5. It also looks stellar when compared to the consumer staples sector median of 21.2. And here we see the 5-year dividend yield chart. The current yield of 2.33% is a 10% improvement upon the 5-year average. Another reason I find shares attractive right now. Now, Simply Safe Dividends gives Kroger a safety score of 71. The dividend considered safe, and while they do have some debt, I see no real red flags with Kroger. These payout ratios look fantastic, really, for any stock, let alone a consumer defensive. The earnings payout ratio is about as consistent as it gets over the last 10 years. 23% of forward earnings, 22% of forward free cash flow. Kroger has an excellent dividend growth track record, 16 years of uninterrupted dividends, so they got through the Great Recession without cutting. Over the last 5 years, that dividend has grown at an average rate of 15% per year, and the latest raise from last year was at 24%. Kroger pays on the first of the month every March, June, September, and December. I just got my dividends today on June 1st as I'm recording this, and that's 26 cents per share each quarter for a total annual payout of $1.04 per share. And in the coming weeks, we'll get word of Kroger's next anticipated dividend hike. In addition to the dividend, Kroger has been fairly aggressive at a share buyback program that has seen the outstanding share count decline from over 1 billion shares outstanding in 2014, and today there are 727 shares outstanding. Just another green flag. We have an average analyst price target of $53.18, and that's at 19% upside from where we are today, looking really nice. I really love Kroger in this inflationary environment, and whether we are or aren't in a recession, these are some weird economic times to say the least, and a company like Kroger is going to thrive in these conditions. I'm also interested in their proposed deal to acquire Albertsons, ticker ACI. If approved, this company is going to become a beast. They will be taking on significant debt. With that, I'd expect dividend growth to slow. I've been buying the stock in my public YouTube portfolio. I've also accumulating it in another private account I have, and my kiddo even owns a few shares of Kroger in the custodial account that I manage. So I'm quite bullish on Kroger. It's probably my favorite defensive pick for 2023, and I'm glad shares have come back into my nice buy range here. Stock number 3 is General Dynamics, ticker GD. General Dynamics Corporation operates in the industrial sector and is part of the aerospace and defense industry. They operate in 4 segments: aerospace, marine systems, combat systems, and technologies, and their primary customer is the U.S. government. Today, shares are sitting right around their 52-week low and have dropped 17% year to date. And it's not often a high-quality company like General Dynamics gives us these kinds of opportunities. Their forward PE is trading at 15.5, and this is about 3% below the 5-year average PE, putting it at a discount to its average slightly. Shares of General Dynamics are yielding 2.57%, which is 11% above its 5-year average yield of 2.31%, making this a potentially decent time to invest in the company if you are bullish on their long-term prospects. SimplySafeDividends.com provides a dividend safety score of 97 for General Dynamics, rating it very safe, and this is the strongest rating out of the group. And the payout ratios for both earnings and free cash flow are right in line with each other, as both are far below the 60% max payout preference. 40% of forward earnings and 39% of forward free cash flow. So this is a stable looking dividend payment. General Dynamics is a dividend aristocrat with 31 consecutive years of dividend raises, and the dividend has been growing at an average rate of 8% per year over the last 5 years. Now, General Dynamics' dividend payout schedule is quarterly in the months of February, May, August, and November in the amount of $1.32 per share for a total annual payout of $5.28. The average Wall Street analyst price target for General Dynamics is, get this, 27% above today's current prices. That's $261.06. There's considerable upside potential with GD. With all the craziness in the world, defense systems are always going to be a necessity, and shares have become compelling. During these volatile times, I think there is more potential downside. But long term, I think this is about as good of an opportunity as we've had in several years to get into a high-quality defense contractor like General Dynamics, dividend aristocrat. All right, stock number 4 is Agri Realty, ticker ADC. Agri Realty is a real estate investment trust. It's a retail REIT. As of December 31st, 2022, the company owned and operated a portfolio of 1,839 companies located across all the lower 48 states. Their portfolio is focused on blue-chip retails, many of which you know and likely invest in yourself, such as Home Depot, McDonald's, Walmart, Costco, many others. The majority of these tenants are household names which make for reliable tenants. Consistent rental revenues. With a near $6 billion market cap, ADC is considered a mid-cap company. Agri Realty has been on a downtrend in 2023, down almost 8% year-to-date, and about $1 above its 52-week low. For REITs, we don't look at PE as a way to value the company. We want to use price to adjusted funds from operations, okay? And ADC's price to adjusted funds from operations is 16.4, and that's a 16.3% discount to the 5-year average of 19.6. Shares of Agri Realty are yielding 4.49%, and this is 19% above their own 5-year average. So both by dividend yield and a price to AFFO, Agri looks attractive. Simply Safe Dividends gives Agri Realty a safety score of 70, so it's considered safe, and this is solid for a REIT on this site as far as their grading scale goes. Now, as a percentage of adjusted funds from operations, ADC is paying out 73%. It looks a little high, but these REITs, it's considered low actually, as they're set up to pay out 90% of their earnings as a dividend, and look at the consistency of that payout ratio. In fact, it's dropping ever so slightly. Now, Agri Realty has a consecutive dividend growth streak of 10 years, just making my cutoff, and the dividend has been growing at a rate of 7% per year. Now, Agri announced a dividend raise every 6 months or so they're doing that multiple times per year. Remember, these REITs do pay a non-qualified dividend, and understand those tax implications, please. Agri pays out its dividend on a monthly schedule, which is quite convenient for those who like that monthly income, such as myself. The monthly payment at this time is 24.3 cents per share for a total annual payout of $2.92. Wall Street analysts have an average analyst price target, $76.88 for Agri Realty, so that's 18.31% upside from where things stand today. Now, what I like most about Agri Realty as an investor is the tenants. There are a lot of companies that I also invest in, blue chip companies. I think of ADC as a smaller version of Realty Income, and as it's smaller, I see more growth potential over the next decade with Agri versus Realty Income. Okay, so that's our 4 picks for June. I think all 4 of these companies are geared to continue raising their dividends and their revenue over the next decade, and I think there is a ton of upside potential. Hopefully, right? But there's a lot of stocks interesting right now, and let's talk about them real quick. Bonus picks. I have first one. Well, I just mentioned Realty Income, and like ADC, I think this is looking really compelling with its 5% yield, safe, reliable dividend. I've added to this one recently as well. I like adding it under like $62 is kind of where I like it. Now, Johnson & Johnson is my next pick here, yielding at 3% now. Look at the dividend king. They've not cut their dividend in 107 years. And of course, their Kenvue business is spinning off later in the year, and J&J will then be more of a pure healthcare play with their pharmaceutical and medical device businesses. And then the Band-Aids and baby oil is going under the Kenvue umbrella. So it's possible the J&J dividend will be reduced by the amount of Kenvue's dividend, which is projected to be about 3% yielder, paying its first dividend in October. But you would be getting that dividend, you'd be getting your shares as part of that spinoff. All right, this one has been controversial, but look, it's a dividend king that's been beaten down hard. We're talking about Target, ticker TGT. Look, whatever you think about the political drama surrounding the company, a year or two from now, it's going to be ancient history, right? Target has an impressive dividend growth track record. Once they turn things around, I think there's going to be a lot of money to be made long term. I'm not a shareholder myself. We put out a video last week showing where I think Target's shares are valued right now, and I'll leave that in the description. I hope you'll check that out. Now, lastly, I mentioned one more REIT, and that is American Tower, ticker AMT. They own and lease communication towers, and these feature a very low payout ratio, double-digit annual dividend growth. Each quarterly payment has been higher than the last, so they raise this thing quarterly. This looks good by all metrics to me. Instead of AT&T and Verizon, maybe consider this as a decent alternative to get a piece of that industry, right? Because even if Amazon were to come in and take over AT&T and Verizon, they're still going to need the infrastructure that companies like AMT have in place. Thanks so much for sticking around. If you're still here, you are my people. I appreciate you. You're probably already subscribed, but if not, if you don't mind, help me out and just click that subscribe button. Thanks. Now, for full disclosure, I do personally own all the stocks I mentioned in this video, except for General Dynamics and Target. Those are the two I don't own. More to come this summer. I'm hoping your June is amazing. Have a wonderful day, and until next time, keep investing.